All right, my friends, I'm going to share with you one of my favorite investment charts of all time. I don't know if they've done the update for 2017 or 18. I don't know. I tried to look. I didn't look that hard, but I didn't find it. But the premise is still the same. It's always the same thing. I'm going to share with you right now from Thornburg Investments. When I first started this started me on the process of realizing what asset location is, as opposed to just old trite asset allocation. Now, asset allocation is simple. All right, so we're going to have stocks, bonds, cash. That's going to be the starting point. Now, of the stocks, bonds, and cash, do we have international stocks, small cap stocks, large cap stocks? Of the bonds, we got municipal bonds, corporate bonds, or government bonds. And of the cash, essentially, be money market stable value from your 401k or CDs. So that's asset allocation. Asset location is you have tax-free, Roth accounts, tax-deferred, 401k, IRA, TSP, and taxable. And everybody and their mom has defaulted to the tax-deferred. I don't want to pay tax now, but I'm in a high tax bracket, or they, without recognizing the premise of how the tax code works. And of course, if they think like that, they've never read my book, The Tax Bomb in Your Retirement. All right, anyway. So asset location is like Roth, IRA, taxable. And I'm just telling you, everybody defaults to the traditional, the 401k, the defer, because that's what the accounts tell us, defer. Then they'll go to the Roth, and then they'll go to the taxable account. And that's we're making a mistake there. And I'm going to share with you why here. So subscribe, my friends. This is big. And I'm just going to screen share the whole thing so that way you can see exactly what I'm talking about here. You're not going to see my mug in here. You're going to see exactly what I'm referring to. This is called a study of real returns from thornburg.com. I'll put a link in the show note. And again, I'm not sure if they got the updated for 2000. This is 14 for 2015, 16. So I don't know. The creation of real wealth depends on the bottom line. Remember, my friends, it's always not what you make is what you keep. Not what you make is what you keep. Here's a nominal return, and here's your real return. We're going to dive into this deeper. This is just awesome. We're going to scroll by this. And we're going to go right here. Let me see if I can't make this bigger. Yeah. All too often, investors chase nominal returns after much of the upside is gone. Quite apart from poor timing, nominal returns are a misleading driver of an investor's investment and asset allocation planning. That's because they don't reflect the erosion of taxes, expenses, and inflation. Moreover, allocation strategies that rely heavily on nominal returns may take insufficient advantage of different investment vehicles that potentially offer valuable diversification benefits. Yep. All right. Example, examining the real returns of individual asset classes over longer periods can help investors build more successful portfolios. More broadly, understanding the real returns facilitates informed investment decisions. The chart below illustrates the erosion of nominal returns from taxes, expenses, and inflation. Was TEI. I got to think about how you say that. TEI. It uses the nominal returns of the S&P 500 and real-world data of the last 30 years. Again, this is back in the end of 2014. Death and taxes. In this world, nothing can be said to be certain except death and taxes, says Ben Franklin. In last year's edition of Real Returns, we examined the dramatic increase in investment taxes in 2013 as part of the American Taxpayer Relief Act while they're raising taxes. Man, if they say we're going to pass a law that says Americans are going to live to 100, yeah, you better make sure you got life insurance. That'll probably mean you'll be dead next year. While we won't revisit all the details here, we remind readers that the hit, while especially hard for those in the top bracket, included people with the AGI of at least 200,000 and married filing at 250. Yep. And this is I don't agree with this so much, but we'll dive into it deeper. Since taxes are the single biggest expense an investor must pay over an investment lifetime, greater than healthcare and household expenses and all other expenses combined, they are a critical contributor to determining what the investor accumulates and has money to spend on, says the Money Management Institute. Citing a research from Morningstar and Ernst & Young, the report noted that tax optimization strategies incorporated across multiple portfolios can generate up to 1.83% per year in an improved after-tax outcome. We're starting to talk about this tax alpha. You're going to hear a lot of people actually starting to come more and more in the vernacular. Recognize we can't beat the market with investment alpha. Alpha just means better than the average, but we can beat the market if we do tax alpha, and thus you should pay me 1 to 1.5% of your investment management fees. I don't buy that for 2 seconds. I do believe there is something called tax alpha without question. We all recognize there's no such thing as investment alpha, but tax alpha you'll hear more and more for high charging financial advisors who want to separate you from your money, who recognize that they better do something differently than try to say we can beat the market, because we know they can't. Anyway, over an investor's lifetime, tax alpha can generate improvements in outcomes as high as 33%. Tax rates do, of course, change over time, as do tax treatment of different investment classes. Over the last 3 decades, the highest marginal income tax rate have run from 28 to 50. In calculating real returns, we use a maximum marginal tax rate in effect at a given time. We assume that dividends were taxed at the maximum rate in the year they were received. For capital gains, we assume they are all long-term, which is the tax treatment is more favorable than that of short-term capital gains. All right, so let's take a look here. We're going to look at right here. We're going to look at, this is the S&P 500. So we got the growth of the of $100 in the S&P 500 from 1984 to December 2014. So we put $100 in, and at the end of 2014, it was worth $2,500 and a nominal return of 11.5%. Now, after expenses is worth $2,161. So we lost $400 in expenses, and they're using a 50 basis points, so 0.5 of 1% expense, which actually I think is pretty nominal, or moderate, I should say, for sure. After dividend taxes, again, when they were the year they received the highest dividend tax at that time, we lost some more money, so we're down. We lost another $500. So we're down to $1,694. After capital gain tax, again, all long-term capital gains, so that'd be whatever the long-term capital gain was at that time, we're down to $1,426. Now, again, our nominal return was 11.34. After taxes, expenses, and capital gains was 9.26. So we only lost was about 1.5%, but we've lost over $1,000 in total gains. Now, after inflation is the big one, we are down to 6.38, and our $100 has only grown to $600 here, to $639. Whereas initially it seemed like we had it to $2,510. Interesting, huh? So remember, highest possible expenses for dividend tax rate, highest possible expenses for a long-term capital gain tax rate. Inflation, I think they're using 2.71. We'll see. It's a real inflation rate for sure. And then we're only using a 50 basis points on for management, investment management. All right. So we're not done yet. We're not done yet. So let's see. We want to talk. Okay. In 2004, letter to the shareholders, Warren Buffett advised investors to remember that excitement and expenses are their enemies. We've already touched on investments, risks investors run when reacting to headlines depicting market volatility and consensus views. Expenses are another critical component of returns. All right. Let's see. This study employs a 50 basis point rate for investment expenses, which we consider reasonable long-term proxy for overall expenses. I agree with that. Now, we don't apply this rate to real estate. A 50 basis point drag on real estate. On homes held more than a year, we deduct the typical 6% commission. So they're basically saying you're going to pay a 6% commission to buy your home as long as you hold it for more than a year. Though we can't build them into our calculations, i.e. expenses. As homeowners know, maintenance expenses on housing can run into the thousands of dollars a year. And trust me, I know that big time. All right, so let's watch this. Here we go. Real returns of annual returns of after taxes, inflation, and expenses for various asset classes. 30 years, 20 years, 15 years, and they got the best performing in these time frames. Large cap stocks is the S&P 500. Small cap stocks is the Russell 2000. International stocks is EFA. Municipal bonds, long-term government bonds, corporate bonds, intermediate government bonds, real estate, which would be just your home, and T-bills. For the 1 year real return, a 6% real estate commission was not deducted for this 1 year real return, but it was for anything over a year. Commodities and T-bills and yeah, 2.71 was what they're using for inflation. All right, so let's dive into this. After all is said and done, large cap stocks still made out better than small cap stocks, better than international stocks, better than municipal bonds, better than long-term government bonds, corporate bonds, and intermediate government bonds, real estate, T-bills, i.e. cash lost money. And inherently that does. It happens. You got to pay a little bit of income tax on it. And on top of that, you're paying. Now, remember, for the income tax, they're using the highest possible tax bracket there was at that time. So it could be from 50 to 28 back up to 39.6 or whatever. I think now it's 37. But this is in 2014. So let's just say it could be from anything from 50 to 28. Commodities actually lost money when taxes and inflation kicked in. So the two things that lost money consistently were cash and commodities when taxes and inflation kicked in. 20 years, large cap stocks still did better. And 15 years, long-term government bonds did better, whereas large cap stocks just squeaked out a positive return. Long-term government bonds did 3.42. Now, I'm telling you right now, everyone and their mom gets all tied up in this long-term government bonds because long-term government bonds did better than stocks did essentially from 1982 until 2011. And probably in a couple of years after that, simply because there's a bull market for bonds. Again, 15.25 was the rate you were getting on a 30-year government bond in 1982. That when that thing matured in the end of 2011, you're trading it in for a 3.25. That's it. So when you have that kind of rates of returns on long-term government bonds, you're not getting anywhere near that today. This is not going to happen today. If a long-term government bond is paying 3.5 after taxes, inflation, it's a losing proposition, my friends. There's just no getting around that. There's no getting around that. All right. Well, we can see commodities consistently did less in terms of net returns after taxes and inflation and expenses. I find that to be incredibly informative. Municipal bonds did better because they don't pay tax on the income. But let's go into this now. I want to talk about something. The big that's just for 2014. Don't care about that 1 year because well behind us anyway. Equities, by contrast, generate most of the returns from capital gains, which are not taxed until they're actually sold, actually realized when the stocks are sold. Qualifying capital gains and dividend income now effectively taxed at the total 23.8% against the highest rate. And this, because most of us are not in the highest rate, would make this even more illustrative because they actually are taxed much less, if at all, for incomes making $200,000 for individuals. While a significant increase from levels before the 2013 tax increases, that's still nearly 20 points less than the top levy on interest income of ordinary income. Despite the long-term outperformance of stocks, investors would be well advised not to put all their money into that or any single asset classes. Yeah, I agree with that. All right, so here's the erosion of total returns over 30 years. Again, the real return of large cap stocks, we lost about 5%, almost exactly 5%, almost half. The real returns of small cap stocks, same thing. The real returns of international stocks, more than half went out the door because of taxes and inflation. Municipal bonds, about half. Long-term government bonds, about 65% went out the door because of taxes and inflation. Corporate bonds, I mean, huge. Remember, because corporate bonds are taxed as ordinary income. Again, so this is for the highest taxpayer. But they lost almost 75% because of taxes and inflation. And you can see, I'll put a link in the show notes here for sure. And they break it down to capital gain taxes, dividend and interest taxes, inflation and expenses. And you can see the 30 years. Look at that. It's nuts. All right, let's keep going down here. This is what I love here. Versus taxable accounts. And this, I'm telling you, I read this back in 2006 or 5 or something like that. And I just, man, it was like an epiphany for me. Okay, right here. Actually, let me go up here real quick. The upshot of real returns for planning. Alongside the appropriate investment mix, portfolio construction must take into account taxes, inflation, and expenses to maximize real wealth generation. Even small moves to optimize portfolio allocation and efficiency can significantly improve returns over time. According to Morningstar Research and the Money Management Institute study, an additional 54 basis points of incremental annual after-tax returns can be achieved by optimally locating assets in tax-qualified or taxable accounts. The type of account in which investments are held can have a huge impact on their real returns. Where have you heard that from before? Yeah, your old buddy Josh. In an IRA or an employer-sponsored retirement account, taxes on interest, capital gains, and dividends are deferred until such investor receives distributions, which are then taxed as the ordinary income tax rates in effect. If the rate is lower than it was during the accumulation, this can produce significant tax savings. But beginning in 2013, the marginal rate for interest income became 39.6. When taxes are deducted for an account each year, this reduces the amount available for reinvestment. In tax-deferred accounts, income and capital gains are allowed to accumulate without taxation, having a potentially cumulative effect. But the chart on page 8A shows the performance of studies various asset class returns over time. And I talk about this right here, asset classes over time. We talk about real returns. Now, I'm going to show you something here. This is large cap stocks over time. All right. So from 1984 to 2014, large cap stocks did better in a taxable account. The dark blue is taxable than they did in a tax deferred account. The reason for that is because dividends and capital gains, long-term capital gains, are taxed much more favorably, and dividends are as well, than ordinary income. So simply by doing nothing but leaving your money in a taxable account for a large cap, you made more than 60 basis points, almost more than half of 1% more return net after real taxes, inflation, and fees, because you converted what would be taxable income as ordinary income into much more favorable dividends and capital gains. Small caps is even the more profound. International stocks, the same thing. You can see taxable account for stocks do better than deferred account for stocks because the deferred accounts is taking qualified dividends, long-term capital gains, and they're moving them to be taxed as ordinary income. This doesn't talk about the step up and basis effect of leaving money to your heirs as well. Conversely, tax deferred accounts do better for government bonds, corporate bonds, and intermediate bonds. Why? Because you're not paying taxes as ordinary income when you receive the income. You're only deferring that to later on down the road when it will be taxed as ordinary income. I just cannot stress this enough. Look at this chart. Stocks do better in taxable accounts because you're moving what would be taxed as ordinary income to much more favorable tax treatment. Bonds do better in tax deferred accounts because it's already being taxed as ordinary income. So we want to defer that ordinary income tax as long as we can. I cannot stress that enough. And we're talking significant difference here. We're talking almost a full 100 basis points in corporate bonds. If you have it in an IRA as opposed to a taxable account. All right. While the real return of corporate bonds over the past 30 years was not 1.93 over the past 30 years, it jumped to 2.82 in a tax deferred account right there. The real return was 1.93 over 30 years. It jumped to 2.82 in a tax deferred account. The 0.89% difference may seem small, but it's actually larger, far larger than the differentials between equity returns and taxable and tax deferred accounts. Furthermore, over 30 years of compounding, the financial impacts of such a difference, which is also quite evident in the real returns of taxable and tax deferred long-term and intermediate-term bonds, adds up significantly. On the equity front, the taxable dividend yield of U.S. large cap stocks is relatively low, so the average return differential between the two account types is minor. The same applies to U.S. small cap and international stocks. What accounts for the disparate income impact on real returns of bonds in the two type accounts? Remember that interest income is taxed annually in taxable accounts and is taxed at the individual's highest marginal tax rate. So the long-run erosion in returns from bonds held in tax-deferred account isn't nearly as it is evidenced in taxable accounts. Investors should consider the implication of tax rates and determine whether taxable or municipal bonds make the most sense for the portfolio. Municipal bonds are fewer in variety and generally pay lower interest rates than taxable bonds, but the interest is usually free from federal taxes. What they're saying is the higher the tax rate in this chart, the more you want the municipal bonds. The lower the tax rate, the more taxable bonds are beneficial. All right, and so I'm not going to dive into that too much. Asset allocation is a primary driver of investment outcomes. When possible, investors should allocations should emanate from long-term horizon. Too often we see investors stung in their pursuit of short-term returns. Okay, yeah, whatever. Same challenge. Okay, we talk about the challenge. We talk about inflation. Here's a huge one here too, my friends. All right, so $100,000 that would have bought $100,000 in 2014 was the equivalent of $7,634 in 1925. All right, so if you had $7,634 in 1925, you had the equivalence of $100,000 in 2014. That makes sense? And that's just because a 2.7% inflation rate. Well, actually, that's based on the CPI. They're using a CPI from 1925 until 2014. Here's the gold standard. Goes off the gold standard in 1971. Thanks, Richard. And you can see the inflation rate just skyrocketing ever since, without question. Again, $100,000 purchasing power in 2014 had the same purchasing power as $7,634 in 1925. Now, in 25 years, at a 2.71% inflation, which is what we're using for the last 30 years, you would need $195,000 in 25 years to have the same purchasing power as you would have $100,000 in 2014. So if your investments are not giving you $95,000 of return pre-tax, you're losing money. That's all there is to it. And then you got to factor taxes in as well. You are losing money because all that matters is the purchasing power. No real gain. This is just the amount needed to stay with inflation. You need 2.71% just to stay on pace with inflation. But don't forget, you're going to pay tax on that 2.71. So anyway, I tell you, man, I cannot stress how much I love this chart. Let me go back here. There we go. And let me go back to me. Stop broadcast. Okay, let me stop screen share. If you're getting 2.71%, you're just beating up with the rate of inflation. You're keeping up with it. But don't forget, you're paying tax on that 2.71. And if it's an ordinary income, i.e. a corporate bond or a taxable bond, you're losing anywhere between 10 to 37%. Right off the gate. So, I mean, right immediately you're losing. You're losing relative to inflation. You're losing money. Your purchasing power is being declined. So we know for a fact you need to get at least 2.71%. It has to happen. It has to happen. You factor in taxes. So don't forget, 2.71, we'll just say you lose 25% to taxes. That's a 2% real rate of return right there. 25, that's just 2%. So if you're only getting 2%, you're losing. You're basically only increasing your purchasing power by 50 cents for every dollar that is needed because of inflation and taxes. You've got to do better than 2.71%. So if you got, let's just say 3.5 and you're in a 25% tax bracket, that would put you basically need 3.75 minus 25%. Yeah, you basically need 3.7% to keep up the 2.71 inflation and a 25% tax rate. Are you getting that? Are you getting 3.7? If you're not, you're losing money. No other way around that, my friends. So you've got to allocate correctly with your location. Corporate bonds, government bonds, you should own, and they should be in IRA. Stocks, you should own, and they should be in taxable accounts. Don't have municipal bonds. That's what it comes down to. All right, guys. Don't forget to subscribe, a thumbs up, comment. We'll see you next time. Thanks now.